Okay, in the previous video we talked about ratios that are widely used and available on most, if not all, financial websites. Now we will talk about a method to use these ratios to try to evaluate what should be fair market price for a stock. So we don't want to pay too much to own stocks. If we pay too much, that will most definitely have an impact on or overall investment performance long term. At the same time, a normal reflex or normal reaction of an investor would be to try to purchase stocks that are selling at a discount. We always want to pay less for more. At the same time, we need to understand that quality has a price, so we want to own quality stocks. So should try to obviously pay less to own our stocks or to sell our stocks at a premium. But at the same time, we should try to evaluate what should be the fair value of the companies we want to own or we may want to sell. So there are different ways to value companies. Some are complicated. We'll talk about one method in the next video called the discounted cash flow model. That is probably more in line with how professional analysts would value a company. But we can also do a quick evaluation by simply using ratios. So basically, we want to use the price to earning ratio to value company. Why? Well, it's simple, as you will see later, and it's also less time consuming than, as I said, build a valuation model and you have to forecast the revenue, the profits, all that stuff. So you can try to save this time to be able to conduct a quick valuation analysis of the company. To do so, we'll use the price to earning ratios of the company that we are considering buying or selling, and we will use the price to earning ratio of its competitors and of its industry to see if the company is currently selling at a discount, at a premium, or is fairly valued. So let's look at an example. Again, it's a fictional company, but you can apply that logic to pretty much every company you would like to invest in. Let's say the company is operating in the telecom industry, and it's the latest financial statements. It declared a net income, so a profit of $10 million. It currently has 25 million, sorry about that, shares outstanding. So 25 million shares are trading publicly. So what is the earning per share? So 10 millions divided by 25 million shares, you end up with 40 cents of profit for each share. EPS, as I said, it's fun to know how to calculate it, but you will easily find it already calculated for you on most, if not all, financial websites. Then let's say that the shares of this company are currently selling at $9 a share. So what is the price to earnings? Well, $9 a share as a price, the current price, divided by the earnings per share, which is 40 cents, you end up with the price to earnings ratio of 22.5. So, is that a fair price to pay? Well, it's difficult to say because we only are looking at one company. So, one way to verify if 22.5 times the profit is expensive for this company is to look at the price to earning its competitors. So again, you would have to choose ideally 5, but sometimes you may only find 4 competitors, maybe 3 sometimes, but 4 to 5 would give you a good estimate. So you will find competitors, so companies that are operating in the telecom industry, ideally in the same market. So if you want to use that method to value fair market price for a telecom company operating in the US, you would try to compare it to other companies operating in the US as well. is going to give you a better comparison. So let's say that we found 5 competitors and the price to earnings are ranging between 22 and 32. What you do is you add them up together. Then we have 5 competitors, so you add them up together and you divide it by how many competitors you're considering. So in your case is 5, and you end up with an average of 27.4. So the average price to earnings ratio of competitors to our telecom company is 27.4, and we could own today shares of our fictional company at 22.5 times the profit, which is lower. So that means we would pay less for the profit of this company than the profit of the average of its peers. Obviously, there's none of these competitors that have a lower P&E, so it could be the company that is trading at a lower price to earnings in the group. So we could conclude that by doing this evaluation that currently our fictional telecom company is selling at a discount compared to its competitors. So, as I said, our telecom companies sell at a discount against the average of its competitors. If the stock market average is 20, normally depends, but you can use 20 as an average overall stock market's price to earnings. So the average price to earnings of every single company trading on the stock markets will be around 20. It will vary obviously, but 20 could be a target to use. So you could say that compared to the stock market average of 20, we're paying 22.4 for a company, so we're paying a slight premium of 10% compared to the overall stock market average. So we can say that the telecom industry, which is asking a price of roughly 27.4, if we compare comparing the price to earning average of its competitors to the average stock market, which would be in the vicinity of 20, telecom industry may command a slight premium from the stock market average. So what could be our telecom's company market value? So if we use the average of its competitors, which is a price to earnings of 27.4, we multiply by the earnings per share of our fictional telecom company, their share could be worth, if we use the average of its peers, $10.96 per share. So we could see that paying $9, which is what our fictional company is currently selling at, would be paying a discount of the industry, which can be interesting, obviously. But before we conclude that we should pay for our company $9 a share, there's always a reason sometimes why a stock is selling at a discount. It could be that there may be a legal action against the company that will have an impact on its price. So if its earnings will stay the same, but if its price drops for bad news, obviously the price to earnings will be impacted and will be decreased. Maybe that the growth of the company is slowing down, so that can be verified from the income statement, the income and the cash flow statements. Maybe the company is losing market share, so are there trends on the revenues that are showing that the company is losing market shares? Maybe the financial health of the company is not in good shape. Maybe the increasing or decreasing revenues are impacting how the market are willing to pay for this stock. Or it may be a short-term devaluation that has no really any specific reasons, and it can be an investing opportunity to pay roughly 10% less than its fair market price. So to be able to use that model, obviously the, the calculation of the price to earnings of its competitors is straightforward. Price to earnings of its competitors will be provided by one click on financial websites. So it's an easy and quick way to do it. But before concluding that the company is overvalued compared to its peers, we just need to make sure that there's no fundamental reasons why. So the companies, we've done our job, we've looked at the profitability and financial health, and that we end up with the potential option to purchase the stock at a discount, then obviously we should feel comfortable. I think that, paying for the average of its peers is not a bad thing. Paying for a slight premium, and if the company is providing solid numbers in terms of profitability trends, revenue trends, financial health is number one, then you may accept to pay a little bit more than its peers. But ideally, we try to pay within the range of the average of the peers, and ideally less. So that's a quick, not necessarily very accurate way to value companies, but it can give you a good insight on whether a company is currently selling at a discount or at a premium, or a company is currently trading at its fair value.